Please note, this discussion is general in nature and does not take into account your financial circumstances and therefore should not be taken as financial advice. Hello, and welcome to a new PFS podcast. I'm Paul, and today I'm going to be joined by Loukasz de Pourbaix from Lonsec. Loukasz is the Executive Director and Chief Investment Officer of Lonsec Investment Solutions, and today we're going to be discussing managed accounts and its functions and benefits, as well as the current market and Lonsec's views on the current markets. We hope you enjoy the discussion. Welcome, Loukasz.
Thanks, Paul. Thanks for having me.
So today our main focus is just discussing Lonsec's managed account, the work around their managed account. So firstly, I'd love to touch on just the way Lonsec structures its managed accounts. So how do they construct the portfolios? What's Lonsec's investment process and their investment philosophy?
Great, thanks, Paul. So look, at the cornerstone of our process is our research. We think we do have a competitive advantage in the depth and breadth of research we do across securities, managed funds, and ETFs. And our investment process and philosophy, ultimately, what we're looking to achieve is long-term growth, but with a strong focus on risk management, and particularly the ability to manage risk on the downside. So trying to limit capital loss over different market cycles. And there's really sort of two elements to that. One is we try to do that through our active approach to asset allocation. So effectively what we're trying to do there is to sort of assess, should we be more in, for example, Australian equities or less into another asset class, and really based on the fact and looking at things like, are assets looking expensive? Are they looking cheap? Is the business cycle conducive to growth, or is it not? And so that's one method, and the other method is obviously through our investment selection process, and that is where we try to identify a selection of investments that we believe are, number one, quality in terms of how they invest, but also from a portfolio construction perspective, ensuring that we're balancing return, but also cognizant of the risks. And this is a real dynamic process. At the heart of the process is our investment committee structure, and that is where we get the experts within Lonsec. So, for example, the heads of the various sectors from the research team, our heads of consulting. We also have external experts, industry leaders on our investment committees. And this is really where we come together and get all those investment ideas, whether it's asset allocation or selecting investments, and we make those decisions on an active basis. And that's we meet either monthly or quarterly, basically to discuss those investment decisions. And then obviously, if there are changes, we implement those within the portfolio. So it's really a research-driven approach underpinned by very strong governance processes and a real focus on strong risk management.
Great. So what I think is great to talk about is, so obviously a lot of advisors and investment houses have been used to manage funds previously, and managed accounts is quite new in the industry. So would you be able to touch on, so what's the difference between the old style managed funds as compared to like the new managed account process? And yeah, what are the benefits of managed accounts over managed funds?
Sure. And so managed accounts are just another way of tapping into, I guess, investments and to achieve an outcome. But managed accounts, if you like to think of it, if you like to think of a managed fund, it's a single fund. You got a unit price attached to that single fund. So, for example, you might be invested in a XYZ balanced fund, and effectively, the manager will manage the assets and so forth. But the client effectively just sees the one line. They're part of a pooled vehicle, whereas a managed account, again, you are managing different types of assets underneath. But there's a couple of things. One is the client does have full visibility on their underlying investments. So if we're buying stocks or ETFs or managed funds, there is that level of transparency of those investments. The end client also has beneficial ownership of those assets. So if you're holding, for example, stocks or whatever investments, the client is the beneficial owner of those assets, unlike a trust structure where you're part of a pooled vehicle in terms of that structure. So there's greater transparency. There's the ability to obviously the beneficial ownership structure. And I guess the other element is, the type of engagement you get with a managed account structure. We find that clients have a lot more sort of visibility, not only on what's in the portfolios, but what's happening within the portfolios. So for example, if we do make a change within the portfolio, that would be communicated to the advisor, and the advisor is very well equipped sort of to then, discuss those changes as well. Whereas in a trust structure, it's sort of, I guess, under the hood. So there's horses for courses. They both play a role. It's just a different way of accessing an investment structure, which has some definite benefits to it.
Yeah. So what I do really like about the managed account process and Lonsec's managed accounts is, so what I've seen, so you can just jump in, you click on the managed account, and then in there you see what investments you have, the percentage, and then obviously Lonsec will, on a regular basis, whenever they make changes, it's communicated the reasoning for changes, and you feel like you're more a part of the investment process, and you feel like you are the investor. Whereas managed funds, you don't really feel like you're the investor; you're just a part of a kind of trust structure, as you said. So that's why I reckon managed accounts, we've been doing them, and we really enjoyed the process and the transparency and beneficial ownership that clients get from being a part of a managed account structure. So more from that, let's talk about Lonsec and their views. So your team's views on the current market. So obviously there's been a lot that's happened over 2020 when the markets fell early in the year, and now they are where they are, close to their all-time highs in America, and in Australia, they're sitting at that 6,000 on the ASX 200, which is still about 20% off their all-time highs. So what are Lonsec's current views on the current markets, and what are you seeing? What opportunities are you seeing?
Yeah, no, it's a good question. And definitely 2020, we've seen it all, haven't we?
Yeah.
So look, so as part of our investment committee process, obviously we discuss the markets, the market conditions. So to your point, look, I think if we look at asset price valuation, so are assets looking cheap or expensive? There's no massive area, like on an asset class level, pockets of big value. Within asset classes, there are, I guess, stocks that look cheap, but the question we have is, are they cheap for a reason? And will they be cheap for longer? And I think if you sort of step back and you think about what has been driving markets for a number of years, and certainly has been amplified in this sort of COVID period, is the role of central banks. So if you sort of cast your mind back to March, and the world was falling apart in terms of on every level, but in terms of investment markets, you saw markets trace back considerably. You saw liquidity dry up in things like the bond market. All of these things were negative, and you saw that in the rapid decline and dip we experienced. But what we saw then was the Federal Reserve pretty much with a bazooka had put liquidity back into markets. And even though, so they were buying up things like government bonds, they were buying up corporate bonds, they were buying up emerging market debt instruments as well. So basically you had this massive liquidity boost to markets, and markets do like liquidity, and we saw that, and we saw the markets sort of rebound quite aggressively. But where are we today? I think there's, if you think about the environment, there's still a big question mark in terms of earnings going forward. It's fair to say, when we speak to companies, there is a lack of guidance. There's a lack of uncertainty because there's just uncertainty. On the flip side, liquidity is still positive for markets. What we're looking at, so we're fairly neutral on our view on, for example, things like equities. We were underweight pre-COVID, post-COVID, and certainly post the announcement by the Federal Reserve in terms of supporting markets with liquidity. We increased our weighting to risk assets such as equities to a more neutral position. And where we are today, really what we're looking at is our base case is that we think the central banks will continue to be supportive of markets, but the other element we're looking at the moment a bit more closely is fiscal support. So if in the context of, like, for example, Australia, things like JobKeeper, we just saw the budget, obviously, and there was it was pretty supportive of, which we think is good and supportive of the broader economy. We're looking at obviously what's going to happen in the United States as well. So, and the other thing we're looking at the moment is obviously we're heading into the US election, and what we do know typically is in that run-up period, there is a lot more volatility. So we're probably holding tight at the moment in terms of where we are. Once we get through the US election, we'll reassess. And if there was, I guess, a bit of a correction in the market, a more material correction, we'd probably look to go further into equity markets at that point. So even though, the overall sort of news people see, is sort of doom and gloom, from a market perspective, there are certainly parts of the market that are doing really well, that will probably continue to be well, but you have to be selective. As I mentioned before, there are some parts of the market, you look at the Aussie market, that do look cheap, things like banks, on a relative basis, things like banks, other parts of the market, but it's probably not an area we'd be going heavily in at this point. So it's about being selective. There are opportunities, but I think we're in a good position to take advantage of once we sort of get through this pre-election period to sort of reassess at that point.
Yeah, so obviously the parts of the market that have been doing really well is obviously tech and somewhat healthcare. So obviously Lonsec has exposure there. So what other parts of the market outside of those main areas that have been outperforming, so the technology like the Apples, the Amazons, the Microsoft, so in the US market, so what opportunities do you see outside of the main tech outperformance that we've had? What areas of opportunity do you see moving forward from here and possibly post the election?
Yeah, so from a portfolio perspective, we're still constructive on things like emerging markets. Now, we increased our weighting pretty early on in the piece into the emerging markets, and we still continue to think that is from a risk-adjusted perspective still creates some opportunities. So we are slightly overweight in that area, and we continue to be that. But maybe if I give you an example of where you've got to sort of dig deeper and look at opportunities. So if you look at the Australian REITs market, or listed property, everyone talks about how it's terrible. Retail is looking bad. It is looking bad. There's question marks around the office sector, for example, as to with people working from home. Is the current sort of office infrastructure environment relevant going forward? All of these sort of things. So there's certainly question marks and there's some headwinds. But even if you look within that sector, there's areas like logistics, warehouses, for example, and those type of companies that are part of that broader property universe that have actually done really well. And the same thing from a stock perspective. While things aren't cheap, we still think that in an environment where there is some uncertainty, we're quite happy to pay for quality companies at this stage as well. So we do think having that quality exposure will give us that growth, but at the same time, in a market where there is a lot of uncertainty, it gives us a bit more defensiveness as well, which we like as well. And hence why, so we continue to focus on those parts of the markets, but it's really sort of case by case. Another area that we've seen opportunities is, for example, in fixed interest, in credit markets. So Again, in that sort of March period, we saw credit markets pull back quite aggressively, spreads blow out, and subsequent to that, we've been increasing our allocation to that, and that's been a very a good type of tilt in the portfolio. It's returned well, but even from an income perspective, in a world with or low income world, it's provided a bit of a income premium as well. So there are, I think the main sort of thing to take out of it, whenever there's a market dislocation, as much as you've got to be aware of what the risks are, there are always opportunities as well. And that's the sort of, I guess, one of the nice things about managed accounts is that we can implement those changes pretty quickly and effectively when we have those sort of shifts in the market.
Yeah, and so when I do have a look at Lonsec's portfolios at current, what I really do love about Lonsec's current portfolio is your main equity holding, which is the quality companies ETF, and so that's exposure to companies such as Apple, Microsoft, MasterCard, Johnson & Johnson, Procter & Gamble. And so I'd like to just touch on this. So I don't know if you're with me on this, but I feel like this is exposure to those sorts of companies over like what a lot of managed funds do have is like an index weight, like a index weighting in their portfolios. Going forward, I actually like really do like the exposure to quality companies as your main equity exposure, because you have exposure to the company's great return on equity, year-on-year growth, and really beneficial for the portfolio. Yeah.
No, absolutely. And that's a very conscious decision. So if you think about that global equity exposure, what we're trying to do is balance our exposure to growth with defensiveness. So things like the quality ETF is a good example where, yes, we do have exposure to those companies with strong return on equity, conservative balance sheets in terms of leverage and so forth. So, you know, in an environment where there is increased market uncertainty, particularly around earnings, and, you know, to my earlier point, some of those companies don't necessarily look cheap, but in an environment where there's uncertainty, and they do have supported by growth, that's not a bad place to be. On the flip side, we also have things like healthcare, for example, which is more included within the portfolio, really to give us that real defensive characteristic. Because we know when markets sell off, sectors like healthcare, for example, do provide us a bit of defensiveness in the portfolio. Conversely, we've got the full exposure to the Nasdaq ETF, so Nasdaq, which is predominantly the tech stocks, which gives us a really high beta exposure to that part of the market. So it's a balancing act, and that's an important part of portfolio construction, is to have that exposure to those growth parts of the market, but also what's in your portfolio to act as a bit of a sort of dampener in terms of if there are periods of volatility. So it's getting that mix right. And we made a lot of changes, as I mentioned, in that sort of just after COVID, when that was a real opportunity to reassess that part of the portfolio. And we think it's well positioned in terms of balancing those two things, but at the same time, giving investors exposure to growth.
Yeah, and that, I think a lot of those changes were made. I think it was in May. So
correct.
It was really good that your team, you weren't really rushed in March when the market corrected. You're happy to have your international equity exposure, but then you took your time, got your investments right. You gained exposure to the Nasdaq. Was it healthcare as well, and infrastructure? So it's really paid off since then. Even the time to pick the right investments has really paid off since then.
Yeah, and it goes to, I think, in one of the key things, and particularly in environments where you are experiencing a lot of volatility, a lot of uncertainty. In those periods, you've got to have. It's important to have a robust process so that you're not making rash decisions, you're not making reactive decisions, based on what was in yesterday's paper. It's about sort of looking at the whole picture, saying, okay, what's the impact? What's the possible impact on earnings? You know, what does liquidity look like in markets? All those things. And at that point, when, you know, if you think about that real sort of volatile period in March, there was just a lot of unknowns. But at the, you know, so from our point, didn't make a lot of sense just to rush for the hills and go to cash. It was, let's sort of reassess. We spent a lot of time speaking to contacts within the funds management world to really understand what is happening within markets, so particularly bond markets, because they were locked up. And, you know, the bond markets are far bigger than equity markets, and most assets are priced off the bond market. So it's a very important part of to understand what's happening there. So it was trying to make, you know, there's always uncertainty and you're never going to get things always 100% right, but it's about having a measured approach underpinned by a process. And that allowed us to sort of say, okay, well, it's not a good opportunity to reassess. And that's what we did. And obviously at the same time supported by the research underpinning each of those investments.
Yeah, so obviously, even in times of volatility, just sticking to your investment process is important.
Yeah.
What I'd also like to touch on is quite an interesting part of the market at the moment is Lonsec's current gold exposure. So gold's been talked about quite a bit as of recent. So I think the gold price at the moment spot is 1,900. A bit off their highs, but gold's done terrifically well this year. I just want to talk to why. So I just want to talk about like the philosophy behind Lonsec's gold exposure. Is that just a hedge against inflation? So obviously with rates on bank balances being zero, and technically if you have that in cash, you're going to lose money every year because inflation takes over. So is that a hedge against inflation, or is that more a hedge against a potential weaker economic outlook?
Yeah, so it's a great question because the answer is both. So from a shorter term perspective, it's really we were looking for an asset that is can act as that real buffer when there's a flight to safety. And our view is that certainly in the shorter term, we are likely to see just periods of episodic volatility, and we have seen that. Certainly, even though the markets retrace back, there has been periods of episodic volatility, and in that environment, gold can really act as a good buffer because there is that flight to safety. So from a shorter term perspective, to your point, absolutely, it acts as a bit of a buffer. From a more, I'd say, medium to longer term perspective, it is that inflation. It is acting there as an inflation hedge. So our base case is, from a short term perspective, we don't think inflation is a risk. But if we look out, you know, maybe 12 months, that is a possibility that we may see inflation reappear, particularly if you think just the rate of stimulus that has gone into the market. And there are other factors as well. And one of the interesting sort of dynamics is this whole sort of, if you think of a world which is maybe sort of deglobalizing to a degree, and if you think of supply chains, so one of the things with COVID, a lot of the big companies were saying, well, we're so anchored, for example, to having some of our manufacturing in China. Now, in this world, is that a risk? You know, do we need to move some of that manufacturing back on shore, for example? Now, if that occurs, which may, the cost of goods will likely go up as well. So that's a sort of longer term sort of view as well. So there are a couple of dynamics at play, but certainly there's a you know, dampening of volatility aspect, and there's a more medium term inflation aspect because gold does tend to provide a bit of a hedge against certain types of inflation. So you're absolutely right, and that's why we added it into the portfolio.
Yeah, perfect. Yeah, I really do like that kind of hedge against the inflation and the economic outlook by using gold. I reckon it's a really good idea to have in portfolios. We'll talk, you touched on a little bit before, even though like, so the companies like Apple and that, they may seem expensive on when you have a look at their PE ratios and all that, they seem expensive. But and then other like areas of the market like financials and energy, they look cheap in the market. So although they look cheap, their outlook is probably not as bright as those of the tech companies and healthcare companies. So what are Lonsec's just current views on those areas of the market? So financials and energy, you still don't have much of a optimism about their future?
Yeah. So if we think about our, the direct equities exposure, the Aussie equities exposure, we have been, trimming that financials position. And if you think about, if you just step back, a low interest rate environment is not necessarily conducive to a lot of those financial, the banks, for example. You've got to think about where credit growth is going to come from as well. So there are a few headwinds, I think, facing that part of, those part of the market. Conversely, if you think of, so there's a lot of uncertainty, and, one of the other stocks, and I think it's one of that we might discuss, is conversely things like CSL, which arguably look expensive at headline level. But if you think about that type of stock, and you think that the increasing demand for blood plasma, the product development pipeline that they have, the earnings metrics and margins within the business. So when you look at valuation, you've got to look at the context of valuation. So if you've got a quality company and all those metrics look attractive, then those valuations, they arguably don't look as expensive. Even with some of the tech stocks, one of the common sort of analogies, or people point to, is the tech bubble back in the late 90s. And at that time, there were absolutely some companies that were under, they were just sort of brands, and there was no sort of earnings supporting those types of companies. If you think about those sort of companies today, like an Apple, as an example, they are supported by real earnings. It's not sort of and I think so there's in a low interest rate environment, that does tend to be more conducive to those growth type sectors as well. So I think you've got to look at valuation, absolutely, but you've got to look at it within the context of the industry and the dynamics at play. Look, at some point, things like financials may look attractive, but at this stage, we're sort of looking at it, but we're preferring other areas.
Yeah, so obviously, I was trying to get to like, the market is a great pricing mechanism. So things are priced at their current levels for a reason, just for their outlook, and there's not really everything. The price of all stocks, they trade at fair value most of the time, because so many buyers and sellers and liquidity, you get a good fair value on based on economic outlook for a lot of stocks. So, but lastly, I just want to touch on last topic, just touch on the upcoming presidential election. So obviously over the past few weeks, the potential for a Democratic sweep is becoming more and more likely. So with President Biden, Vice President Biden becoming president, is becoming more and more likely come November 3rd. So how is Lonsec viewing this, and what risks and opportunities does the Democrats in-house represent?
Yeah, it's an interesting one, because it is a topic we did discuss within our investment committee. If we sort of look at history and how it's sort of played out. So if you take away the emotional aspects of it, and everyone's got a view on Trump or Biden, it's probably everyone's will be no doubt watching closely what happens there. But if you think about it, what history tells us, and that's not a bad way to start, is leading. What are markets like? Markets like certainty. They don't like uncertainty, irrespective of what it is. So at the moment, there is a lot of uncertainty either way, and hence you're seeing markets go up, up and down. And, if you think about at the moment, there's a whole debate around the whole sort of fiscal package, I guess, and it's a political football at the moment. So markets don't like that type of thing. In terms of once we get an election outcome and we get some more clarity, I would argue that markets are in the immediate period, markets will just like certainty. And they'll say, well, okay, we know what we're dealing with now, and they can price for that. So markets are more concerned around having certainty of what's happening rather than saying, well, we like Biden or we like Trump. Longer term, medium term, certainly, if there was a view on, I guess, taxation and all these sort of things, that will sort of be priced into the market. But I think our view is less around, it's going to be bad if Biden wins or good if Biden wins or vice versa with Trump. It's more around the market just wants certainty. We think the markets will probably stabilize a little bit post the election because there'll be a known outcome. And again, if you think about big elections in recent years, so you think of, or big events, so you think about Brexit in Europe and, leading up to that period, I mean, the consensus view in the market, was that if Brexit got voted in, then markets will capitulate. It was the opposite. If you think about when President Trump got in, again, leading up to that environment, the consensus view was that markets are going to capitulate. It was the opposite. And I think it's the opposite, not because there's a view on, is it the right thing or the wrong thing? It's markets like certainty. And I think that's the main thing to point out. You can pontificate about, is it going to be good, bad? But I think that's the bigger picture. And certainly from our perspective, we're not making, we discuss what the possible implications will be, but we're not certainly making any investment decision based on a possible outcome. Because that I think, look, history tells us that it's very difficult to make a sort of an investment view based on those things.
Yeah, exactly. And then once you get past the election, you can rethink and plan for the next 4 years, depending who is president at that time. But yeah, that's all we're going to speak about today. So thank you, Loukasz. It's been great to talk with you, and great to have the Lonsec team on board. And I know us, the team at PFS, we're really looking forward to having a good, lasting relationship with Lonsec moving forward. And we really do believe that our clients will really, really like the what Lonsec provides and offers. And yeah, I'm looking forward to doing more of these for many years to come. I hope so. And yeah, thank you so much for today.
No, thanks, Paul. And yeah, very happy to do more of these. I've enjoyed it a lot.
Thank you.